Last month, the Federal Reserve met and the Fed did not cut the rates, and mortgage rates actually went up. If you've been asking, will mortgage rates go down in 2026 or should I wait to buy a house? Last month, you were pretty much handed the answer, and it's not the one most people expect. If that paradox makes no sense to you, that confusion is the exact reason most people time their home purchases wrong. I'm a mortgage advisor licensed in New Jersey and Pennsylvania. I watched this happen in real time on real rate sheets, not on cable news. So let me answer the question almost nobody explains clearly. Does the Fed actually set your mortgage rates? And walk you through what the brand new Fed chairman just signaled today. Here's what almost every single person gets wrong. They think the Fed sets their mortgage rate. It doesn't. And last month is the cleanest proof you will ever get. The Fed did nothing last month. The new chairman opened his mouth introducing himself and the mortgage rates jumped. Stick with me. I'll show you the one number that actually controls your mortgage rates. I'll show you the time the Fed cut rates and the mortgage rates went up anyway. And I'll tell you exactly what to do about it if you're buying a house in 2026. Let's start with what really happened in the Federal Reserve meeting last month. The Fed held its rates steady in the range of 3.5 to 3.75. Here's the part that matters. The last meeting was Kevin Warsh's first meeting as the new chairman for the Federal Reserve. He replaced Jerome Powell last month, and Warsh is what people in my world call the hawk. Years and years back, he sat on the Fed board and he actually resigned rather than to go along with the Fed printing more money. When he talks about inflation, the market takes him seriously. And last month, he talked tough. Even with the loud political pressure to deliver a rate cut, he held the line and made it clear the Fed is not done fighting inflation, which is still running at about double their 2% target. Their own projections moved the wrong way for buyers. A few months ago, they expected to be cuts in the rates by now. And last month, they hinted the next move might actually be rate hikes, not rate cuts. Most likely it's gonna happen before the end of the year. Let that sink in. The new chairman's message to the market was not relief is on the way. It was the rates may have further to go up. Traders heard that and they started betting on a possible hike by the fall of this year. The decision itself was to do nothing with the rates. The words that Warsh said, that's what did the damage. Within hours of the Federal Reserve meeting last month, the average 30-year fixed rate climbed back to around 6.6%, erasing any progress that they had made that week. No rate change and higher mortgage rates. Let me explain how that's even possible. This is the one idea that I want you to walk away with, that the Federal Reserve does not control the mortgage rates. So when people ask, does the Fed control mortgage rates? The honest answer is only indirectly. The Fed rate and your mortgage rate are two different prices set by two different things. The Fed controls exactly one thing, the interest rate that banks charge each other to borrow money overnight. That's it, nothing else. Super short-term money between banks is what the Fed controls. Your 30-year mortgage is not overnight money. So when you want to know where the mortgage rates are headed, you don't want to watch the Fed headlines. You watch the 10-year Treasury. Right now, the 10-year Treasury yield is sitting right around 4.5%, and the mortgage rates roughly track a couple of points above the 10-year Treasury yield. When the 10-year Treasury yield goes up, your rate goes up, no matter what the Fed did. Think of it this way. The Fed is the weather forecaster, but the bond market is the actual weather. The time that the Fed cut their rates and the mortgage rates actually still went up. If you think I'm overcomplicating this, let me give you the clearest example in recent history. Back in September of 2024, the Fed cut rates by 0.5 point, the biggest cut of that year. Going into it, mortgage rates actually were holding right around 6%, the lowest in 2 years. Every headline said the same thing. Rates are falling, the cut is here we go. Then came the Fed meeting. The Feds did cut the rate back in November, and then they cut again in December of 2024. A full 1% of cuts in just a few months. What happened to the mortgage rates? Do you know? The mortgage rates actually still went up. They climbed back up over 7% and stayed there because of the fact that the bond market looked right past the Fed cuts. They worried more about the inflation and the government borrowing instead. So what happened was the 10-year treasury yield went up and your mortgage rates went up with it. And that gap is real money. So let's say you went and you borrowed $500,000. The difference between a 6% mortgage rate compared to a 7% is roughly $300 a month, every single month. So over the life of that mortgage loan, that's about $100,000 difference because of the percent rate. That is the price some buyers paid for waiting on a cut that actually made things worse. Everybody in that time thought the Fed rates were falling, it's gonna cause the mortgage rates to fall, and they all felt that waiting for the rates to continue to fall was a safe option. This is the exact mistake that I'm trying to keep you from making. If you're buying in the next year or so, the worst thing you can do is freeze and wait for the mortgage rates to drop. That may never come. In one call, I'll show you your actual rate as of today, your actual monthly payment, and a plan to lower it if the mortgage rates were to fall. It's a free strategy call, no pressure. The link will be in the description. What do you actually watch instead of the Fed rate? Watch two things: the 10-year treasury and the Fed's tone. Inflation is the enemy of your mortgage rates. When inflation looks sticky, or when a hawk like Warsh says we're not done, bond investors demand a higher return to lend their money out, especially over the long terms. That actually pushes the 10-year treasury yield up and your mortgage rates with it. That is literally what happened last month. No rate change, hawkish words, and higher rates. So should you buy a house now or wait for the Fed rates to drop? Here's what I tell my own clients. First, stop trying to time the exact bottom. Nobody, including myself, know where the mortgage rates are gonna settle, and their rate cuts don't guarantee lower mortgages. Second, get fully approved before you start searching for properties. And it's not the same as getting pre-qualified. Getting fully approved is actually getting an underwritten approval. So when the right house shows up, you can actually move on the offer in days, not weeks. And number 3, marrying the house and dating the rate. That's the actual real truth. You can always refinance if the rates were to fall in the future, but you can't rewind a price or unloose a bidding war. Don't bet your budget on a refinance that nobody promised you. Buy the payment you can actually afford with today's rates, and treat the future refinance to a lower rate as a bonus, not the plan. And once you're under contract, ask about your lock options. Some setups actually let you lock in today's rates and still capture a lower one if the market were to change and improve before your closing date. So that's exactly the kind of thing we set up together, so you're protected if the rates were to rise and still be positioned if the rates were to fall. Let me kind of zoom out, because the same thing that moved your mortgage rates today actually are also moving Bitcoin. And a lot of you hold both. The same hawkish signal that pushed the mortgage rates up also pushed Bitcoin prices down. As of today, it's sitting right around $56,000. So why would the Fed move crypto? Same reason it moves almost everything. Bitcoin and other risk assets run on liquidity, on how much cheap money is actually floating around in the system. Higher for longer actually means tighter money, and tighter money is a headwind for crypto, causing it to fall. Loosen the cost of money, that has historically been a fuel that sends Bitcoin running up. Here's the point for someone building wealth in both worlds. Your house and your Bitcoin are quietly trading the same thing. They're both trading the Fed's tone and the direction of money. That's also why in my last couple of videos that I posted, I showed you how to use your crypto as a documentable asset for a mortgage application and how borrowing against your crypto can beat ever selling your crypto. It's the same game, it's just a different table. Let's bring everything home. The Fed held the rate last month. The new chairman came out swinging on inflation. The bond market flinched. The 10-year treasury went up and your mortgage rates followed. No rate cut required. That's the real machine. The Fed makes the headlines, but the bond market is what actually sets the mortgage rates. If you want someone to promise you that mortgage rates are about to crash and you should just wait for the mortgage rates to fall, that's not me. Last month's news on the Fed meetings isn't that either. But if you're in New Jersey or Pennsylvania and you're planning to buy in the next year, you want a real plan built on today's numbers instead of a headline. Book the free strategy call in the description so we could kind of sit down and go over everything. We'll map your mortgage rate, your payment, and your timing in about 20 minutes. And if today's rates have you thinking there's no way you can afford to buy right now, watch the video on buying a 2 to 4 unit investment property and letting your tenants cover most of the cost. That's how a lot of people are still getting into buying a property, even at today's higher rates. And we'll see you on the next one.